Welcome to HB Accountant's very first podcast, Episode 1, the Autumn 2024 Budget Playbook. We're thrilled to have you join us as we outline one of the most important financial events of the year, the Chancellor's recent budget. I'm Vicky Foster at HB Accountants, and I'm here to introduce you to two incredible experts who are here to help unpack what the autumn budget means for you, your business and your financial future. We have Amy Thompson, who is a tax manager here at HB Accountants, and Andrew Willis, a financial planner from Grosvenor Wealth Management. Now, I do need to read out a compliance statement. Grosvenor Wealth Management Limited is authorised and regulated by the Financial Conduct Authority, and HB Accountants are governed by the Institute of Chartered Accountants for England and Wales. This podcast is for general information purposes and is not intended to constitute investment, tax or legal advice. We recommend you seek independent advice before making any investment. Tax treatment is dependent on individual circumstances and may be subject to change. And the value of investments can go up as well as down, and you may not get your original amount invested back. So, back to our podcast. Amy and Andrew, together, you're going to walk us through the key budget changes, sharing insights on how the decisions that you make can affect your money, your wealth, and the way you manage your business. Whether you're a business owner, an investor, or just someone keen to make sense of the financial landscape, you won't want to miss this. So let's get started and break down what the budget means for you. So Amy, thank you for joining us on our very first HB Accountants podcast.
Yeah, really exciting. Hopefully the first of many, getting modern and up to date here.
Absolutely. So the budget, autumn budget 2024, what do we need to know?
So the first area I'm going to go through is inheritance tax. So the inheritance tax threshold, this was due to start going up with inflation, but the Chancellor announced that it's actually going to remain frozen. So it will remain at £325,000. One of the big changes, which I'm sure Andrew will discuss further, is from April 2027, inherited pensions are going to be subject to inheritance tax. So from April 2027, most death benefits under registered pension schemes will be included within members' estates for the purposes of inheritance tax. If a pension is left to a spouse or civil partner or falls within the deceased's nil rate bands available, it will not be taxable. If the pension is subject to inheritance tax, then there could be the possibility of double taxation where a lump sum is paid for a member who dies after the age of 75. If the recipient is not a spouse or civil partner, there may be an inheritance tax charge. The residual lump sum will also then be subject to income tax. So the next big change was to business property relief and agricultural property relief. So business property relief, which is commonly known as BPR, is a relief from inheritance tax which applies to the transfer of relevant business property. Relief is currently given at either 100% or 50%. Agricultural property relief, or APR as it's known as, is a relief from inheritance tax which applies to the transfer of qualifying agricultural property. So from April 2026, agricultural property relief and business property relief is going to be reformed, with the highest rate of relief remaining at 100% for the first £1 million of combined business and agricultural assets, on top of those existing nil rate bands that I spoke about earlier. The rate of relief will reduce to 50% after the first 1 million, so technically 20% inheritance tax will be due on estates that have business property relief and agricultural property relief over £1 million, not taking into account the nil rate bands, of course. The changes to business property relief, or BPR, will affect people who have invested in AIM shares, which I'm sure Andrew will talk about shortly. So this relief is per individual, and therefore it's important to note that married spouses can each benefit from the £1 million allowance. However, this allowance cannot be transferred between spouses on the first spouse's passing. Therefore, it's important to start putting planning into place to ensure that this relief is being used on the first spouse's passing. For example, it's important to leave the assets ideally to a chargeable beneficiary of the estate, rather than the spouse whose assets pass to free of inheritance tax. So also, offshore trusts will no longer be able to shelter assets from inheritance tax, and there's going to be transitional arrangements for people who have made plans based on the current rules. If this affects you, I'd recommend you get in touch with us because the rules are quite complicated, so I won't go through them any further here.
Okay, what about changes to capital gains tax?
So capital gains tax was something that was discussed quite a lot before the budget, and actually the changes weren't as far-reaching as we thought they could have been. So they did still change those, so we'll go through those. The capital gains tax rates will increase from 10% to 18% for basic rate taxpayers, and from 20% to 24% for higher rate taxpayers. This matches the existing rates for residential property, which stay the same at 18 and 24%. So all the rates for all basically capital gains are aligned now. Okay. Business asset disposal relief, which is known as entrepreneurs relief, but changed the name recently for some reason, will remain at 10% for up to the first £1 million of gains generated, before rising to 14% on the 6th of April 2025 and 18% from the 6th of April 2026. So those looking to sell assets that fall within this regime should ideally look to do this before 6th of April 25 if possible, to ensure they benefit fully from the 10% rate.
So what assets are we talking about?
So entrepreneurs relief and entrepreneurs relief or business asset disposal relief as it's known now applies to certain assets that are sold. So usually it relates to things like shares in a personal trading company. So people are selling shares in a trading company and they own over 5% of those shares. They've also got to have owned those shares for 2 years. So it's really important to take into account ownership periods when looking at this. It also relates to sole traders when they're selling their business, so self-employed individuals who have their own business. It also applies to assets sold that are connected with that business. But there's lots of different conditions that need to be met before you can fall within this regime. So if you think that you might have an asset that falls in within this regime and want to sell it, it'd be really important to contact us first.
Get in touch and get advice.
Definitely, yeah. So the final thing on capital gains tax is that the tax treatment of carried interest will be reformed by increasing capital gains tax rates to 32% straight away, and then from April 2026 it'll be moving towards a revised regime. So we don't know a lot about that now, but we'll provide a further update once we know about the legislation. It's important to note as well that the capital gains tax rates increase were immediately as at the 31st of October, so the day after the budget was announced. So that's important to note that they've changed immediately, apart from obviously business asset disposal relief, which will be increasing from 6th of April 25.
And the changes to stamp duty, land tax, when do they happen?
Yeah, so immediately from the 31st of October 2024, so the day after the budget, the higher rate for additional dwelling surcharge, so this is when you're buying a second property on top of your main residence or, more than that, so it will affect people purchasing buy-to-lets who already have their own main residence, will increase from 3 to 5%. So this means now that the lowest rate of stamp duty on these kind of properties, so second dwellings or, more than second dwellings, will now be 5%, and the highest rate 17% for resident purchasers, and 7% and 19% respectively for non-resident purchasers. So from the 1st of April 2025, the temporary change in thresholds for stamp duty that were brought in under Liz Truss's mini-budget in September 2022 are coming to an end. So this wasn't announced in the budget, but it's something that was automatically coming to an end anyway on the 1st of April 2025. So it's important to point out because stamp duty rates are going to go back up. So these thresholds on when you start to pay are going to be changing. So from 31st of March 2025, the stamp duty rates on a standard residential purchase of a freehold property for an individual that is a UK resident and replacing a main residence will be as follows: 0% up to £125,000, 2% for above £125,000 and up to £250,000, 5% above £250,000 and up to £925,000, 10% above £925,000 and up to 1.5 million, and 12% above 1.5 million. So these weren't changes announced in the budget, but I think it's important to point out anyway. First-time buyers as well are going to be hit pretty heavily by that relief that was coming to an end as a result of Liz Truss's budget, because first-time buyers will now pay stamp duty on purchases of property over $300,000 from 1st of April 25. This has dropped from $425,000. And the maximum purchase price for which first-time buyers relief can be claimed is currently at $625,000 and will return to the previous level of $500,000 from the 1st of April 25.
And no changes to income tax and national insurance for employees?
So not for employees, no, but there is going to be big changes for employers, which eventually will trickle down to workers. So as much as they say that it's not going to affect employees, it eventually will, because it will affect wages, bonuses, job hiring. So I think it will have an impact on employees as it trickles down. So to go through the income tax and national insurance changes, so the Chancellor announced that the income tax and national insurance thresholds in England and Wales will remain frozen until the end of the 27-28 tax year, so up to the 5th of April 2028. After this, they'll begin to rise in line with inflation, which is good news. Rates of income tax and national insurance paid by employees will remain unchanged. However, employers' national insurance will rise from 13.8% to 15% on workers' earnings. The threshold at which employers start to pay tax on each employee's salary will also be reduced from £9,100 a year to £5,000 a year, and these changes are coming in from the 6th of April 2025. The employment allowance will increase from £5,000 to £10,500. The eligibility of the allowance has been expanded to include majority of eligible employers, rather than those with a national insurance bill of less than £100,000 a year. And changes to corporation tax as well, not too many, but it was announced that the main rate of corporation tax paid by businesses on taxable profits over £250,000 will stay at 25% until the next election. The current capital allowances system will be maintained, which includes permanent full expensing and the £1 million annual investment allowance, and the current R&D relief will remain as they are.
Okay, and can you tell our listeners about the changes to the non-domicile regime?
So domicile is the concept of basically where you consider your home to be. So at the moment, there's quite beneficial rules for those that are UK resident but non-domiciled, which means they consider their home to be elsewhere. So this current non-domicile regime is going to be abolished from the 6th of April 2025. And from 6th of April 2025, the current regime will be replaced with a more residence-based test. So this new regime will be available for up to 4 years, starting from 6th of April 2025, or the first tax year in which the individual becomes UK resident if later. During those 4 years, new arrivals to the UK will not be subject to tax on their foreign income and gains, or distributions from non-resident trusts. So these can be brought into the UK freely without attracting a tax charge. Those opting into the 4-year foreign income and gains regime will lose their entitlement to personal allowances and annual exempt amounts for CGT. So foreign income and gains can be brought free into the UK freely without attracting a tax charge under the new regime. Those opting into the regime will lose their entitlement to tax-free income tax personal allowances and the annual exempt amounts for capital gains tax. This new regime will be available to any individuals who have been non-UK resident for at least the previous 10 tax years. But qualifying individuals who have been tax resident in the UK for less than 4 tax years by 6th of April 2025 will be able to use the foreign income and gain regime for any remainder of the 4-year term. After the initial 4 years, individuals will be taxed on their worldwide income and gains in accordance with the normal rules for UK residents. It's important to note that we haven't had all of the legislation on this yet, so as soon as we have, we'll provide a further update.
Perhaps we can do a podcast
Potentially
on
another
non-dom.
podcast. Yeah.
Fabulous. Making tax digital. What can you tell us about that?
This has been dragging on since I came into the tax profession 10 years ago and still hasn't been introduced. Well, it has for VAT, but not for income tax. But making tax digital for income tax will be mandated as follows. So from April 2026 for sole traders and landlords with relevant income over £50,000, and from April 2027 for sole traders and landlords with relevant income over £30,000. So
what does that actually mean for the sole traders and landlords? What are they now going to have to do?
So they're going to have to submit quarterly returns to HMRC. So it's going to be a lot more compliance. It will be good for HMRC because they can see the figures in real time, and it means that payments will be made earlier, because payments will need to be made, potentially, we think, based on those quarterly returns that are submitted.
So more administration.
So more administration, more data collection, have to do it earlier. So it's going to be on a quarterly basis rather than that one singular tax return for the whole tax year.
And if you failed to meet the deadline, presumably a fine.
Yes, penalties and interest will be due, but we don't know the full ins and outs of the regime yet. But as soon as we do, we will obviously give a further update, probably a podcast. But also we're going to get in touch with our clients we know are going to fall within this regime early next year. So we'll be in contact and let you know more. The Chancellor also announced that by the end of the Parliament, which we think means from April 2029, sole traders and landlords with relevant income over £20,000 will be mandated to use Making Tax Digital for income tax. Another point as well on the management of taxes. So interest on the underpayments of tax will increase by 1.5% from 6th of April 2012 onwards. This means that the rate will be calculated as the Bank of England base rate plus 4% rather than 2.5% as present. So quite a big increase, especially for people who are paying corporation tax late.
So that's potentially a big chunk extra
in late payment interest to make, yeah. Finally, VAT, not many changes, but just to point out, the standard rate will remain at 20%, and VAT at the standard rate will be added to private school fees and boarding services from the 1st of January 2025.
Thanks so much, Amy. Turning to you, Andrew, can you tell us what are the key points from our financial planning perspective?
Hello, Vicky. It's great to be here on HB's first ever podcast. Well, it was a highly anticipated budget, especially seeing as it was the first Labour budget in 14 years, and of course the first ever by a woman Chancellor of the Exchequer. As usual, there was lots of speculation, and I guess much of it was wrong, as is always the case. Pre-budget, we have spent a lot of time reassuring our existing clients that it's more than likely best for them to wait and see what was announced rather than act on the hearsay, rumour and speculation that was rife. And I think we've been proved right there. Acting on rumour, clients could easily have ended up in a worse position. Following on from the budget, we're stressing pretty much the same thing. Wait and see. Take time to consider the changes, as many are not coming in until April 25, 26 and even 2027. So timing is important to avoid making anything worse than it needs to be.
Well, let's discuss a change that's happened immediately. Capital gains tax rates.
Yes, capital gains tax is one of the more likely increases, and it was fairly well flagged, albeit Rachel Reeves didn't go as far as many people expected. There was no change in the annual exemption of £3,000, but an increase in the rate for basic rate taxpayers to 18% and 24% for all others. And on the sale of their own business, it's also increased to 18%. Amy's already been through that. So the key thing here is that capital gains tax will account for the majority of the £40 billion of tax rises announced, and the changes to the annual exemption over the last few years, plus this increase in tax rate, is likely to see other investments such as investment bonds come back into favour.
And any change to ISAs?
No changes to ISAs at all. The allocation annual amount that you can put in has remained at £20,000 per person, despite speculation. The proposed British ISA has been dropped after a very lukewarm response. Use of the annual ISA allocation remains an excellent way, really, to invest for the longer term. It's still very tax efficient, and we can use it to roll over CGT-able investments where appropriate and where allowed.
So where did we see the biggest changes and or surprises?
Well, the changes to inheritance tax, they were the biggest areas the surprises came from, and some of it was anticipated, but a lot of it wasn't. So the thresholds, as Amy has already pointed out, remained unchanged again, and they're not going to be amended in this Parliament and not before April 2030. So that's good news for people with a main residence property and other assets, as the nil rate band and the residential nil rate band would see potential £500,000 outside of the estate for inheritance tax purposes, £1 million for a married couple or those in a civil partnership. So everything over and above that is potentially taxed at 40%. In this regard, business relief, whether that's the sale of an owned trading company or BR investment, that's offered 100% relief after 2 years if held at the date of death. But now, in some circumstances, that's going to be reduced to 50%. So Amy's already mentioned AIM shares, and in some cases over £1 million held in BR investments. So an effective tax rate of 20%. But this doesn't come into fruition until April 2026. Now, business relief and agricultural property relief is limited to a total of £1 million per person from April 2026, with assets in excess of this only receiving 50% relief. So again, we have this effective rate of tax of 20% coming into force. Enterprise investment schemes and venture capital trusts have maintained their status, and tax reliefs extended now until April 2035. But any unquoted shares in seed EISs or EISs will come under the £1 million limit. We know, of course, that EISs and corporate business relief plans remain high-risk investments, and always take advice before looking to take one of these out. But they do have some advantages and will continue to have a market. One area of inheritance tax that did come out of the blue, though, was in regards to pensions. Now, this won't have an impact on anybody who has an annuity, but for those in SIPs or personal pensions, those in drawdown pensions, if they've got any unused pension funds or death benefit at the date of death, then these will be counted into the estate, which is a change of approach. This will not apply where the funds go to the spouse or civil partner, as there still is no inheritance tax between husband and wife or civil partner. But if it goes to any other beneficiaries, such as children or grandchildren, etc., then it will. The existing pre-75 tax-free death benefit, that's not changed, and the current post-75 death benefit, where the beneficiary is taxed at their marginal rate, that also hasn't changed. However, with this introduction of the inheritance tax coming into force, and then it is possible that we're going to be looking at double taxation, so inheritance tax for some beneficiaries and income tax at their marginal rate as well. Now, these changes have a consultation period until 22nd of January 2025, and as I say, the rules themselves will not come into effect until April 2027. Now, there may well be changes to what's been announced, and this is certainly one area where making a quick decision would not be the right course of action. Please take advice. Please take your time to do what is right for yourselves. Now, it's possible, of course, that we're going to need to advise clients to revisit their expression of wish nominations, to consider more about annuitising their benefits, and if they're already over age 75 and they haven't taken their tax-free cash, that they would consider doing so to avoid this double taxation. So there's a lot to ponder, but from our point of view at this moment in time, we would say it's better to sit on one's hands as far as possible, wait till the fog clears and we've got greater clarity on if and when these changes will happen, and any changes to what has been announced is announced.
Wow, some big changes to consider there and to take advice on.
Yeah, no, absolutely, Vicky. We do know some ways to help reduce the impact of these changes, but as I've said, timing is absolutely key, so take advice before doing anything. Today really is simply about making people aware that these changes have occurred and will occur over the next 2 to 3 years, and that need to be planned for and will need to be assessed properly before action is taken.
So, there we have it. As we wrap up today's podcast, a huge thank you to Amy Thompson from HB Accountants and to Andrew Willis from Grosvenor Wealth Management for joining us today and sharing your valuable insights. Their expertise, we hope, has given you a clearer picture on how the recent budget impacts on your personal and your business finances. If you would like to receive an email summary of what we've covered, drop us a message and we'll be happy to send the details your way. And of course, our podcast will be up on both of our websites for you to listen to again should you wish to. Lastly, thank you for joining us, and we look forward to supporting you on your financial journey. Please remember that information shared in this podcast is for general information purposes only and doesn't constitute professional advice. And while we aim to provide accurate and up-to-date insights, HB Accountants and all of our guest experts are not responsible for any actions taken based on this discussion. We'd recommend always seeking advice suited to your specific financial or business circumstances. Thank you so much for listening. We're thrilled to have you as part of the HB Accountants community. Your support and engagement means a lot to us, and we look forward to bringing you more insights and more discussions that will help you on your financial journey. Until next time, take care and feel free to reach out if there's anything we can help you with.